Dear students, welcome to the lecture series on financial management. Today in this lecture, we shall cover the topic tools of financial management. Under tools of financial management, we shall learn the various aids which are available for analyzing the financial statements of a company. These tools are projected balance sheet, which we have covered in our previous lecture, then accounting ratios, cash flow statements, cash budgets, and comparative financial statements. As we have already covered in our previous lecture, projected balance sheets, so we will continue with the other tools of financial management. The objective of this lecture is to have an insight of the various tools available for analyzing the financial statements of an organization or any business firm. It is done so that a useful information can be derived for the interested group of people, where they have to base their decisions on these financial data and take up the corrective decisions in a very rational and judicial manner. These ratios will depict either long-term position of the organization or short-term position of the organization. They are to be analyzed in the light of liquidity, solvency and profitability. So, we will learn them in detail, its features, methods of computation, various formulas associated with these techniques, the formats in which they are prepared and how they are being useful. Let us understand first of all what is accounting ratios. A figure given abstract or alone does not represent anything. If we compare something, we have to compare it in a rational manner. There should be, if we say that something is 40 and it's out of 100, so what the figure 40 is representing and what the figure 100 is representing, we have to analyze it with the help of a arithmetical equation. Then and then only we can ascertain that it's showing something. If I say that the temperature is 35 degrees centigrade, whether it's a higher temperature or lower temperature, it's not going to give me any meaning. But if I say that the temperature of southern side is 17 degree or northern side is 18 degree, and then we can make an analysis where it is high, where it is low. So, the figures should be compared on an equitable level. They should be compared using some relative ratios. If I say that my sales are 400 and my profit is 90, so what happens that we have to analyze whether this profit is at which ratio. So, we have to establish a relationship between profit and sales so that we can ascertain the percentage of the profit. So, accounting ratios are called as arithmetical equation or arithmetical relationship of two datas compared together to arrive at some meaningful presentation or to get some meaningful information for the user. Let us analyze these broad categories of the accounting ratios. So, first one we are discussing is liquidity ratio. By liquidity, what do we mean? Liquidity means that we should have that much of liquid assets in our hand so that we can pay off our current liabilities. Now, what do we mean by solvency? Solvency means that the person or the organization should have an asset backing so that he can pay off his liabilities in the near future. It is not necessary that he should have liquid cash or ready cash with him. Solvency denotes the going concern assumption. That means whether he is solvent enough that long-term loan can be given to him or he has adequate asset backing with him by which he can bear this debt onto him. Last is profitability. Profitability means that whether by carrying out the business operations the firm is able to earn the revenues or not, whether the venture which in the company is there, that means where the venture is able to earn or fetch money from the investment it has made is called the profitability. It denotes the operational efficiency of the firm. So these three should go hand in hand. There should be a perfect coordination between these three. If a person has adequate liquidity but he is not solvent, what does it denote? It denotes that he has lot many cash in his pocket, but this cash doesn't belong to him. It must be a borrowed fund. So he has lot of liability onto him. So his solvency is in question. Take a very easy example of it. If you go to some coffee shop and you have to pay something for it, right? So in that case, you should have adequate liquidity with you. That means you are able to pay the price of the coffee you have drink there. So that's the meaning of liquidity, that adequate cash or ready cash is available with you to pay off your liability. If you go there and you don't have the liquid cash to pay off, they won't give you anything. While solvency denotes that you are taking a short-term loan. You are going to the coffee shop saying that I have a big bungalow, so you can give me some credit. So they will see whether you have adequate liquidity or not. So they are simultaneous. Generally they are used as synonymous, but they are not so. They are different concepts, but they have to go together. That means if there is something absent in the organization, either solvency or liquidity, again its going concern entity is in question. So they are perfectly coordinated ratios and we have to analyze them in detail. So let's take the first ratio called liquidity ratio. As we have right now discussed that liquidity means how early we can get back the cash and use that cash to pay off our current liabilities. Current liabilities means the near liabilities or the liabilities which we have to pay off regularly or monthly, or it can be short term liabilities of less than a year. Short term loans could be there, short term credit we have taken from somebody, they needs to be paid off. So there are certain ratios which we have to learn under liquidity ratios. The first one is we have to ascertain working capital. Working capital denotes current assets over the current liabilities. So current assets should exceed the current liabilities, where the giver of the money has a reliability that you have adequate current assets so that you can pay off the current liabilities. Second is current asset ratio. Current asset ratio is computed as follows. It is current assets over current liabilities divided by current liabilities. So it's a ratio of current assets to the current liabilities. The ideal current asset ratio is 2:1. That means the assets should be double of the liabilities. So it will present the strong short-term financial position of the company. Now another aspect is certain other rules could be there for RBIs where they can frame a lesser ratio. That means 1.67 to the 1 is also a prevailing current asset ratio. So its determination depends upon the company or the sector from which the industry is belonging. So they can set as per their prevailing practices, but ideal ratio so set by the management is 2:1. Now let's take an example to understand how to compute the current asset ratio. If my current assets are 4 lakh rupees and my current liabilities are 2 lakh rupees, So current ratio will be 2:1 and it will show a strong financial position of the company. What if the current ratio is less than 2:1? Take an example. If the current assets are 1,60,000 while the current liabilities are 2 lakh, so it will give a figure of 0.8:1. So it's showing that the short-term working position of the firm is not strong. They don't have adequate current assets to pay off the liabilities. Their liabilities are exceeding the current assets. Now we will learn the computation of current asset ratio. Current asset ratio is computed using the formula current assets over current liabilities. Current assets is to be divided by current liabilities. This ratio is computed as a ideal ratio if it is 2:1. So if an organization has the current asset ratio as 2:1, it shows the strong financial position of the company. And if it's less than 2:1, it means that they don't have adequate current assets to support its current obligations. Now let's understand what is comprised of current assets and current liabilities. Current assets means those assets which are short term in nature. So here following list should be kept into mind when we compute this ratio. The current assets shall be stock. This stock will have all the stocks: stock of raw material, stock of work in progress and stock of finished goods. Now second one will be debtors. Debtors are receivables and they should be net. Net means that any provision for debtors or for discounts or bad debts have been made, they should be accounted for and a final figure of debtors should be considered. Bad debts provision is to be taken into account. Next one is bills receivable. They are denoted as B/R. If any, they should also be included. Then cash in hand plus bank balances plus investment. When we talk about investment, this investment should be short term investment or temporary investment. It should not be the long term investment. Now what are short term investments and what are long term investments? Short term investments means investment in the marketable securities which can be readily converted into the cash, while long term investments means investment in subsidiary or any trade investment which is made on a longer period for long term project. So we have to include the short term investment in the list of current assets. So together they shall comprise of current assets. One more thing, prepaid expenses shall also be the part of current assets. Prepaid expenses are those expenses which are being paid in advance. Their liability is not yet generated, but we have given a advance money in against the expenses. For example, we have given the rent for a period before the 12 months. That means if 14 months rent is given, we will take 2 months rent as prepaid rent and include it in the list of current assets. So these current assets together will give us the figure of the current assets which we have to use in the numerator. Imagining it to be 4 lakh, we will write current assets as 4 lakh. Now what shall comprise of current liabilities? Current liabilities shall include creditors, bills payable, bank overdraft, provision if made any, plus outstanding expenses. Outstanding expenses are those expenses which have remained unpaid for the current financial period. That means instead of 12 months we have paid off the rent for 11 months. So 1 month's rent which is outstanding shall form the part of current liabilities. And these lists are not the exhaust list, they are inclusive lists. We can add other current assets which are falling under the category of current assets. For exemplifying, we are understanding this list. So these are the current liabilities. So considering all these current liabilities as 2 lakh, we will compute our current asset ratio. So it will be 4 lakh divided by 2 lakh. It will give us the ratio as 2:1, and it is an ideal ratio. It will show that the short-term financial position of the company is strong, which denotes that company has adequate current assets to pay off its current liabilities or obligations. Now, the RBI committee has suggested a ratio lower than 2:1, which is 1.67:1. So, this is the format by which we are going to prepare the current asset ratio. This calculation is very easy and it's very rational to evaluate the short term financial position of our company. Till now we have learned about these 3 ratios. That is, under liquidity head we have learned about working capitals, which is computed using the formula current assets minus current liabilities. Then we have learned in detail current asset ratio, that it is computed as current assets divided by current liabilities, and ideally it should be 2:1. Anything which is lower than 2:1 will show that the liabilities are exceeding assets, or in other words we can say that our current assets are not adequate enough to pay the current liabilities. Now we shall concentrate on the third important liquidity ratio, which is known as liquid ratio. It is computed using this formula, liquid assets divided by current liabilities, and it should be 1:1 in the standard ideal format. That means the assets and liabilities should be equal when we compute liquid ratio. Now, liquid assets are those assets which are readily convertible into money. So, there is a list of liquid assets which shall be current assets, which is as good as current assets except stock. Now, the liquid assets shall comprise of cash in hand, cash at bank, bills receivables, debtors. These debtors should be net debtors, and it should not include stock, because stock is not readily convertible asset. It has to undergo the production cycle or operating cycle. So when we talk about liquid assets, we should keep in mind that those assets which we can sell in the market, or from which readily cash is into our hand, by which we can convert them into cash, we will use those assets as liquid assets. Those investments in the marketable securities are also liquid assets. Current liabilities will be same as that of the current asset ratios. That means bills payable, creditors, outstanding expenses, provision for taxation if any, provision for the debtors, or the proposed dividend if any, they shall all form part of the current liabilities. Its ideal is 1:1. That means, let's see the example. If the liquid assets is given as debtors 20,000, cash 10,000, and bank balance as 20,000. So our liquid assets will be 50,000. Now current liabilities are given as creditors 20,000, provision for taxation 20,000, and outstanding expenses as 20,000. So they are 60,000. So putting these values in this formula, liquid assets divided by current liabilities, we shall get 50,000 divided by 60,000, which is coming as 0.82. It is less than 1.1:1. That means our current assets are not adequate to cover up the current liabilities. Here liquid assets are falling short to pay the current liabilities. So the liquid position of the company is not favorable. So this is the method of computing the liquid ratio. Now there is a little variation in the liquid ratio and it is called as quick ratio. Its formula is quick assets divided by current liabilities. Here current liabilities shall exclude bank overdraft, while in other formulas bank overdraft was also forming part of current liabilities. Certain books have given other way of computing quick assets where they have used cash and bills receivable only as the quick assets. So quick assets there denotes cash plus bank plus bills receivable divided by current liabilities excluding bank overdraft. While we can use the same liquid assets also as quick assets and change the denominator. Both the methods of computing the quick ratio are correct. So with this we have learned the major formulas for computing the liquidity ratio. These are working capital, current asset ratio, liquid ratio and quick ratios. So we will move for another formulas or another set of formulas which denotes the profitability of the company. They are the profitability ratios. We have learned the ratios based on liquidity. In our upcoming lecture, we shall learn another two parts of the accounting ratios which are based on solvency as well as profitability, because liquidity, solvency and profitability has to go hand in hand, which we have learned in our lecture. So continuing this lecture, in another part we will learn about profitability and the solvency ratios. We are ending up our lecture of today where we have learned about the accounting ratios, their relative measure and the methods of computing each type of liquidity ratio, whether working capital, current asset ratio, liquid ratio and quick ratio with their ideal measures as well as their method of computation. Thank you.